Herald Linde is head of Asia Equity Strategy at HSBC. Herald, great to have you with us here on the program. Thanks very much. Just to kind of start with what's happening in China, do you think we'll see a firm policy put coming through, some policy announcements, etc., with this big MPC which kicks off today? What's your sense?
I'm not quite sure. So, yeah, the Chinese market needs confidence to come back. And there's a few ways this can happen. And a lot of people hope, of course, that this National People's Congress will provide some of that confidence. Now, I understand that some of the GDP data will be announced today. It looks like they're talking about 5%. How they're getting there, something that we need to know. Unfortunately, the press conference with the economic czar in China has been cancelled, so we don't get a lot of details there. But I think maybe sometimes markets are putting too much hope on these large events. The other way how we can actually get some sense of confidence coming back in China is simply through the earnings season. We are in the midst of earnings season. By the end of this month, a lot of companies need to have announced their results. So we need to see that decent earnings are coming through, at least better than expected. Not the levels of growth that we see in India, but at least something around maybe 13, 14, 15% earnings growth in last year. Because we still don't have the 2023 numbers in. So that's something we need to look at as well. But for the moment, all the eyes are on the NPC. That's correct.
Okay. Herald, hi, good morning. All the eyes also are on the Indian equity markets that are sitting at all-time highs. And, it is a bit disconcerting when almost all asset classes are sitting at new highs, right? Would you be a bit concerned at this point in time, or do you think that the run could continue, in Indian equities at least?
Yeah, in Indian equities. So I think this can continue, but the pace of it probably is good if it slows a little bit. Now, what is encouraging, last time we spoke about what is the risk that if China rallies, the money goes to China, that it will come out of India. And I argued at the time, well, maybe it actually could come out of Japan. Now, what we've actually seen is that neither of these two things have happened. We've seen quite some money flowing into China over the last, say, 4 or 5 weeks or so. That money has not come out of Japan, neither out of India. It's actually come out of other markets around the world and gone into Asia. So India is being separated from China. That's one good thing. So it's not being used as a funding base for China. The other thing I think is also healthy in India, and we spoke about this last time as well, we saw a lot of small cap stocks rallying, and we see in India that is losing a little bit of steam. I think Nigel was talking about it earlier as well. Now, that I think is also healthy development because the value lies in the large caps, not so much in the small caps, I think. And we need to see a bit of that rotation just to balance the market out. What we now need to see is that growth in China will be okay-ish, that some kind of confirmation comes there. And we need to see throughout this year that interest rates in the US are going to gradually move lower. And I think you guys were talking about it earlier as well. The Fed is saying, hey, they might cut, but maybe we put it on hold afterwards. So there's a bit of discussion about that. But if we see these interest rates slowly go lower, bond yields slowly, gradually lower, that will provide support for equities in general and Indian equities as well. So I still think, yes, India is a bit expensive. Maybe we shouldn't see a big rally from here anytime soon, but we see macro globally as well as the dynamics in the market fairly healthy, actually.
All right. Hi, Herald. Morning and good to hear your views. From the large cap names, since your preference is out there in the Indian markets, what are your liking? And also the point that you made on the Fed. We had a guest yesterday, Mr. Yardney. He made this point that maybe we don't get a rate cut in this year. I don't think equity markets are prepared for that. Your view on that as well?
No, if that would be right, if we don't see a rate cut this year, the market would have to reprice a bit. Probably not by a lot, but it would be a negative for the market because some rate cuts are being priced into global equities at the moment. We don't think, I think consensus is that there will be some rate cuts. But what we've seen at the beginning of the year that everybody said, hey, we're going to set rate cuts probably in March. That's then already being pushed backwards. And now we see the first voices saying, well, maybe we don't see a rate cut whatsoever because the underlying US economy is still doing pretty good. Our view is that we see some rate cuts, but a little bit later than what the market initially was anticipating. And you see this in bond yields, right? In the beginning of the year, they came down, they've gone up a little bit again. And I suspect they will slowly go down. And that would probably support global equities and Indian equities to a certain extent as well, but not a hell of a lot, not as much as what we've seen the last couple of months. Now, when it comes to stocks you want to look at, I mean, we like the large cap stocks, so it's financials and maybe selected IT and consumer names there. But I think if the market trends higher, but not so fast, it's going to be individual stories. And we see this in other markets as well, Japan and Korea as well. It becomes increasingly on individual stocks where something is happening. Now, you have some corporate action in certain stocks in India. That's where the action is going to be done.
All right. Well, yes, that is where the action is at the moment, especially names like Tata Motors, etc., that we're going to talk about in a while from now. Herald, thanks a lot for joining in.